Hey, it's Joe, and this is the 8th installment in the Quant Trading and Futures video series. Today's topic is risk management and position sizing. We're going to start out with position sizing and specifically managing to a target volatility. So our target volatility is our desired level of annual volatility. We'll denote that by V. And note that V divided by the square root of 252 will give us the daily volatility. Let RI train and RI test be the return series over the training and testing periods respectively for parameter set I and 1 to n, and let it have weight WI. So these variables are defined just as they were in the last video on portfolio optimization. And furthermore, let R train equal W1 R1 train plus all the way through to WN RN train. So R train is the linear combination of the return series for parameter sets 1 through n over the training period, weighted by the weights we computed via the risk parity calculation that we discussed in the last video. And let R test be defined analogously. Let sigma be the volatility over the training period, so sigma equals standard deviation of R train. And let the multiplier M be the target daily volatility, that's V over the square root of 252, divided by the volatility over the training period, which is sigma. So M equals V over square root of 252 sigma, and we're going to multiply R train and R test by M, which will give R train annual volatility of exactly V and R test annual volatility of V in expectation. So let's break this down. R train starts out with volatility of sigma. We divide by sigma, and now it has volatility of 1. We multiply by V over the square root of 252, and that means that R train now will have volatility of V over the square root of 252. And when we annualize that, we multiply by the square root of 252, and that will give R train annual volatility of exactly V. And the same is true for R test, with the exception that the annual volatility will be V only in expectation. Of course, we can't forecast exactly what the volatility will be over the testing period. But the assumption here is that the volatility over the testing period in expectation will be the volatility over the training period. And so by doing this calculation, we can get very close to our desired level of target volatility V over the testing period. So with that in mind, let's dive into the position sizing formula. So this is the equation we use to compute the number of contracts for each parameter set. And it is Ni equals S times Wi times V times K times M, all divided by the square root of 252 times sigma. So what do these terms mean? Ni is the number of contracts we're trading for parameter set I. S is the weight assigned to the strategy. Wi is the weight assigned to the parameter set. V is the target annual volatility. K is the capital amount, the account size. M is the scaling multiplier. We'll talk more about that later. And sigma is the volatility over the training period. So let's try to break this equation down into smaller parts. Notice the V divided by square root of 252 sigma. We talked about that on the last slide. That's how we're normalizing to our target level of volatility. Multiplying by K, the account size, will give us our dollar volatility rather than our percent volatility, which we had previously had from V divided by the square root of 252 sigma. So that takes care of V, K, square root of 252, and sigma. After that's done, we multiply by Wi, the weight assigned to that parameter set. That's pretty self-explanatory. We multiply by S, the weight assigned to the strategy. That's also pretty self-explanatory. And finally, we multiply by M. M is the scaling multiplier. We're going to talk a lot about that later on. For the sake of clarity, let's go through an example calculation. So let S equal 1, Wi equal 1, V equal 15%, K equal 100,000, M equal 1, sigma equal 200. Plug that into the formula. You get Ni is approximately 5. I'm rounding here just to make the example simpler. So the target daily dollar volatility is going to be Vk over the square root of 252. Let's break that down. V is our target annual volatility. Divide by the square root of 252. You get your target daily volatility, but this is in terms of percent. This isn't in terms of dollars. So you multiply by K and you end up with your target daily dollar volatility. Plug in the numbers and you get approximately 1,000. So what is the volatility over the training period? That is the volatility from trading one contract. So the volatility from trading one contract is 200, and we want volatility of 1,000. We're going to trade 5 contracts, and that matches up with the formula. But do note that this only works if the trading decision is binary, meaning that the trading algorithm either gives a buy-sell signal of one contract or it makes no trade. The assumption here, once again, is that the volatility over the trading period, that's coming from trading one contract. If the volatility over the trading period comes from trading more than one contract or less than one contract, then this calculation is going to be wrong. So in some sense, the calculation is strategy specific, and it will need to be tweaked depending on the details of the specific strategy that's being traded. All right, so it's finally time to trade. We've come a long way to get to this point. And the first thing we do is we compute NI for every parameter set, the number of contracts associated with that parameter set. We say that a parameter set fires when the trading algorithm associated with that parameter set gives a buy or sell signal. So if the trading algorithm for that parameter set is saying yes, go ahead and trade, we say that parameter set fires. If it's saying no, don't make any trade, we're saying it doesn't fire. And for a given market, we're going to trade the sum of the number of contracts for all parameter sets that fire for that market. Let's go through an example. Let's say we're trading ES, the E-mini S&P 500 futures, and we have 10 parameter sets, each with NI equals 0.2. 4 of the 10 fire, so 4 of them are saying yes, buy. The other 6 are saying no, don't make any trade at all. So we'll trade 4 times 0.2 equals 0.8 contracts, rounding up to 1 contract. And you can think of this as a voting scheme. The more parameter sets that vote for a given trade, the larger size will trade. In that sense, our trade size is proportional to the strength of the signal. If all the parameter sets are in agreement saying trade, we're going to trade very large size. But if only a small fraction of the parameter sets are in agreement that we should trade, then we're going to trade a smaller size. So we trade bigger when the signal is stronger and smaller when the signal is weaker. And now we're going to discuss scaling. So remember that scaling multiplier number M in the number of contracts formula. Where is that number coming from and how is it computed? First of all, scaling is a dynamic tool for risk management. We compute the scaling multiplier number M between 1/5 and 5, and this number is updated daily. That's what makes this dynamic risk management. Multiply the number of contracts by M, just a reminder that M is in that formula for computing NI, and the purpose of scaling is to decrease the position sizes when risk is high, increase the position sizes when risk is low, and generally speaking, smooth our returns distribution. So there are 3 primary factors that go into our scaling multiplier calculation. They are our current positions, the VIX, and our previous month's volatility. So to begin, current positions, the idea is that if we already have big positions on, we want to trade small. And if we have small positions on, we want to trade big. So what we don't want is to end up in a situation where at certain times we have enormous positions on and hence an enormous amount of risk. And at other times we have almost no positions on and we're not generating any returns. So the idea is to decrease our position sizes when we currently have big positions and increase our position sizes when we currently have small positions. The next factor is the VIX. The VIX is the CBOE volatility index. It is the expected volatility of the S&P 500 over the next 30 days. The idea here is that if the VIX is high, there will likely be more trades in the next month and hence more risk, so we want to start decreasing our trade size now. Now granted, this may be specific to my flagship trading strategy because my trading strategy trades a lot more frequently when volatility is high. And so there's going to be more risk when volatility is high. We start decreasing our trade size now. But this factor may not be relevant to other strategies. Just want to point that out. And our final factor is the previous month's volatility. So volatility tends to cluster, meaning that if last month's strategy volatility was high, we expect high volatility this month, so we need to decrease our trade size now. And these 3 factors together are what we use in order to compute our scaling multiplier. And now we're going to do the actual scaling multiplier calculation. So we run linear regressions over the training period to predict the magnitude of returns. And we'll do both a simple linear regression for each scaling factor and a multilinear regression using all 3 scaling factors. Why both regression methods? It's because the multilinear regression is good because it gives the appropriate weight to each factor. But the issue is that there could be multicollinearity amongst the factors, and that could throw off the predictions from the multilinear regression. The simple linear regression isn't going to have issues of multicollinearity, but it isn't giving the appropriate weight to all the factors. So the solution is we use both regressions, and we're simply taking an average. So that will give us the predicted magnitude of returns. From there, we compute each model's scaling multiplier by dividing the target daily return magnitude, that will be V divided by the square root of 252, by the predicted daily return magnitude, sigma hat. So M equals V over the square root of 252 sigma hat. The expectation of M will be 1. That means that scaling multiplier in aggregate is neither increasing nor decreasing our position sizes. It is only increasing and decreasing our position sizes at certain times, which is exactly what we want. And furthermore, we will bound M to be between 1/5 and 5. We don't want to be either increasing or decreasing our position sizes by more than a factor of 5. But I will point out that to get a scaling multiplier as extreme as 1/5 or 5 would be very rare. It would only occur in situations where we have almost no risk on at all, or where we have a ton of risk on. And most of the time, this number is going to be close to 1. All right, so putting it all together. As I alluded to earlier, we're going to be doing some averaging. So we compute the final scaling multiplier by taking the geometric mean of the 4 scaling multiplier numbers. We're going to refit our regressions each month. And the desired effect of all this scaling is that the tails of the returns distribution, especially the negative tails, what we're concerned about, are pushed toward the center. So I have 2 pictures here. The one on the left is a fat-tailed returns distribution, and the one on the right is a more normal-looking returns distribution. And this is really the desired effect of our scaling. It's not really going to affect our returns or our volatility, so our Sharpe ratio will be roughly the same, but we are going to decrease our expected shortfall. We're going to decrease our max drawdown. So by cutting off those tails, we can reduce our risk while keeping our returns roughly the same. And that's what makes scaling a worthwhile endeavor. Okay, so let's recap the risk management techniques we've discussed. First of all, the most powerful risk management tool we have at our disposal is diversification. We want to trade many different strategies across many different markets, across many different parameter sets, with an equal amount of risk allocated to each parameter set in order to spread our risk out. And finally, we want to apply scaling to decrease our position sizes when risk is high and increase our position sizes when risk is low. So that'll be it for this video on risk management and position sizing. Next video, we're going to discuss execution.